All right, we're live. Thank you for joining me. I'm Mitch Goldberg. It's been a couple of weeks. Took a little break from the live stream. As I'm sure many of you took a break from something that you might do every day and love, but once in a while, it does get a little burdensome, a little burnt out. You get a little burnt out once in a while. So you just want to take a break from what you love to do, even if you love it, just to recharge your batteries and think about directions, things you want to do. And that's exactly what I'm doing with the show. So I love the way the show is, and it's changed over the few years. We talk about money, mostly stocks and investing, but we talk an awful lot about Social Security and other matters of personal finance, how to save money, how to just be better with money. It's a personal choice, and there are just many personal choices we make all the time. Today, I want to talk to you about some important things. They're all important. None of them take a long time to talk about. So I will be able to be quite brief today, but these are important things: the yield curve, why the market was down, some of the tech stocks, and overall oil getting crushed as well. So I'll roll the intro and we're going to be off in a minute, but I want you to watch this because this sets the tone for the rest of this holiday shortened week and probably easily for the week. We get the non-farm payroll reports on Friday, but that's not going to change anything that we talk about today. So pretty timeless stuff. Here we go. All right, we're live. Thank you so much for joining me, and hope you don't mind. I'm going to be brief also because I really messed up my back doing bent over barbell rows, which I do all the time, and it's one of my favorite exercises. And this time, just the warm up set just buckled my back. This has never happened to me before. It has been truly an agonizing 24 hours, but I'm happy to say I'm doing a little bit better as the day goes on, feeling much better, getting up and down out of a chair without crunching my teeth and being in excruciating pain. So, everyone out there, wish me some luck. How about wish me luck by giving me a thumbs up for watching the show? Whether if you're watching on LinkedIn, if you're watching on Facebook or YouTube, that would be really cool. Even if you watch this in the replay, not the live, it's still the same show. So you get to watch a show all night whenever you want. And it's a good, darn show about money and investing. So let's just talk about a couple of things real quick. All right. So the Dow down 626 points. Remember about 2 weeks ago, 2 weeks and a day ago, the Dow was down a little bit over 1,000 in one day, and people made a huge fuss about it. So much so that I was actually I was actually on TV for it. It was a big deal. Okay, twice 2 weeks ago. And as far as that being a big deal, 626 points, 1,000 points. When you're up here at 41,000, just about 41,000 in the Dow Jones Industrial Average. By the way, you cannot invest directly into an index, but you can invest into a security that tracks or mimics an index. It's not as big of a deal as it used to be. We've seen plenty of 1, 2, and 3% down days. It's really nothing unusual. They do come in clumps. I find in my experience, you kind of get these when you get these down days, like 2, 3% down days, 4%. They usually come in clumps. They you have a few days like that. They calm down. You have a few more. And from the selling that took place a few weeks ago, it appears that it's not really over. We had a relief rally. We spoke about this. And if you were worried about your investments and if you were worried about the stock market, you were worried about how the down market could affect your retirement and your lifestyle and your future and all of these things because, you live and die based on the market, right? Now, you shouldn't be doing that. But if that's the case, and what we've talked about constantly is with the reprieve in the market coming back, it wasn't even down that much 2 weeks ago. Yeah, I know it went down 1,000 points in one day. I get it. But it's percentage wise, it's not that big of a deal. We just had a huge run before that. So we gave up a little bit of that. No sweat. But people get greedy and they only look at where they were at their highest peak, and then they look now when the market's down and say, wow, I'm losing money, not thinking that in the last year and a half, you made a ton of money in the market. But you only look at where you were from a recent high. It's a little game that people play with themselves, and I think you have to stop playing that game uh, and be realistic about it. So the Dow down 626 points. It looks like the selling's really not over, and the problems that we were worried about, in particular, a slowdown in tech and tech valuations way too high. Now, listen, tech growth is still accelerating. I should say it's still positive, but it's not accelerating the way it used to. And this is what happens when stocks and markets are priced for perfection. The artificial intelligence trend, okay? It's artificial intelligence is a multi-trillion dollar opportunity, but the market cap of the artificial intelligence slash tech sector has gone into many trillions of dollars of valuation. So we may have already seen those valuations reflected in the prices of the stocks. And even though Nvidia last week beat its earnings expectations by a drop, and they were a really good report, the stock has gone up so much that investors really just want more. Because the more investors get, the more they want. Until eventually you can do no right, no matter how good you are. It's a really tough position to be in. This is why we advocate rebalancing, taking profits when necessary if a position is too big in your portfolio. And these are the things we need to talk about because a position that's too big for your portfolio might be just right for somebody else's portfolio. So, this is why we talk one on one. And if you'd like to discuss these topics one on one, you could reach out to me. Information is below on the ticker. Okay. So moving on, the tech stocks have gotten crushed. Let's go back to the screen. Okay. So the Nasdaq was down over three and a half, down over 3.25%. So more than doubling the drop in the Dow. The S&P was down quite a bit as well, down over 2%. Oil plunging down to 70. I kid you not, I saw gasoline here on Long Island for like 268 a gallon at a gas station in Melville this morning. So gas is coming down too. This could be perceived as a pretty big break for consumers heading into the winter. The peak driving season ended with Labor Day. I hope everyone had a really nice summer, by the way. I know some of you are going to say, well, of course oil is going down because of politics. You have an election. And I I can pretty much assure you that's not why oil is going down. Oil goes up and down for many reasons. And if you're worried about a softer landing, the fact is there's plenty of oil around the world. Everybody is well supplied. We are trying to hurt supplies coming out of Russia, but it's not really working that well as long as China and India will buy up everything that they can pump. And we've discovered more oil in different parts of the world. And shale producers basically went from nothing to something like 12 million barrels per day in the last 20 years. There's a lot of oil demand. What happened with oil sanctions with Russia is that it just shifted the customer producer relationship. So now we're just North American oil is ours, a little bit of it is exported, and Russian oil goes to China, Iranian oil goes to China. We really don't get that much oil. We get very little oil actually. We get very little oil from the Middle East these days, but that's a story for another day. Gold still 2,500 plus, coming off a little bit. The VIX is elevated quite a bit up to 20. That typically is what happens when the stock market has a big down day. Other stock indexes that I like to pay attention to is the Russell 2000, which is down a lot. So much for the small cap stocks being a bit of a safe haven slash panacea for investors to hide in. I want to show you something even more important than all of this. This is the yield curve. Okay, the yield curve. And this is not what I wanted to show you, but let's go back to the watch list. I'm going to find out what I'm looking for over here. Here it is. The 2-year yield curve, okay, is flat. Let's look at the full detail, okay? You hear a lot about the yield curve and how it went negative, and that portends a recession. The yield curve has been negative for what, the last 2.5 years or so. Believe it or not, the yield curve does not signal a recession until it goes from negative back to positive. Because when it goes to positive, it means that short term rates are coming down because the Fed is cutting rates because it's worried about a recession. So now, I mean, I said the yield curve is flat, but it's 0.03 to the negative. So barely negative. It's just about flat. And what does a yield curve mean? This is not so important in the graph. This is what you really need to know is the yield curve. This has been the lowest I've seen it in some time. So the yield curve means is that typically if you buy a 1 year CD and let's say it's paying 4%, you would expect a 10-year CD to pay about 5 or 5.5%. Typically, long-term rates are higher than short-term interest rates, but it goes inverted when short-term rates are actually not lower but higher than long-term interest rates. And that's usually a signal of a slowdown in the economy. Market rates that are set by investors, like 10-year treasury bond, mortgages, that sort of thing, those could go down. Now, maybe mortgage rates are a little bit elevated now, but they have been going down lately. But in the case of treasuries, the 2 year is higher than the 10-year. But now that the economy appears to be slowing, we could debate all day long a soft landing, a hard landing, or something in between. Maybe we're going into a recession. Maybe we're just having a slowdown. Either one, the Fed is expected to start cutting interest rates later this month. And and when that happens, it's expected that short-term rates will go below long-term rates and we'll have what's called a normal yield curve where short-term rates are lower than long-term rates. But when that happens, it's usually because of a slowdown in the economy. And that is when the stock market starts to take a hit because corporations can't meet their earnings expectations, or they're not, or they have a tougher time, I should say, meeting investor expectations for earnings and revenues. More layoffs, fewer people paying taxes into the system, into the IRS and state coffers, fewer people having jobs, more people on government support, and an overall general consumer pullback, consumer spending pullback. So that is a little stuffy today. I'm sorry. That's a little bit of what's happening now. So this is when we could actually see the stock market maybe correct. And a lot of people are saying, "Oh, but the market goes down when the market." I'm sorry. A lot of people say the stock market goes up when interest rates go up, and it goes down when inflation goes up. Well, we've had inflation that's been pretty high interest rates, and the stock market went up. People have these things backwards. I don't know where these old mantras come from, but the stock market actually pulls back in the beginning of rate cycle cuts. And then finally, the economy is stimulated by rate cuts, the economy improves, corporate earnings go up, and then the stock market goes back up. So that's why this could be a precarious situation for investors, more so than a lot of people expected. It's become fashionable to talk about how highly valued the stock market is. You know what else has become fashionable? Looking for stocks that are not tech. A lot of articles all over the website, CNBC, they're all talking about how important it is to find stocks that are not tech. And you're seeing articles like 3 dividend stocks for a weaker economy, 5 dividend stocks or high yield stocks or undervalued stocks to help you weather a down market. Listen, if you are worried about a down market, you could raise some cash also. You're not a hedge fund. You don't need to be 100% invested at all times. If the market goes down, dividends typically won't save you. Diversification typically won't save you either. Diversification is a strategy that we use to help mitigate risk, but it doesn't necessarily protect your portfolio from going down in a generally down market. Dividend stocks don't necessarily prevent your portfolio from going down in a generally down market. Maybe they go down less, but they still go down. And over the decades of experience that I have in this business, I've spoken to so many investors over the years, 70 and over, who decided to buy dividend stocks thinking they're so smart and so safe based on some article they read or something they heard on TV or something. And then those stocks get killed. They're like, oh, what happened? I can't believe I'm down so much on these dividend paying stocks. A lot of times a high dividend yield stock is a problem child because the company's earnings are going lower, the stock price is going lower. So the percentage of the dividend, the dividend percentage yield is higher, so it looks attractive. But what happens is, as a company's earnings go down, they can no longer sustain that dividend. The dividend gets cut, and your whole reason for buying a stock is obliterated. And often you're stuck with a company with poor fundamentals. This is why just being a dividend investor in and of itself, I think, is a fool's errand. That's right. And before somebody says, Mitch Goldberg says that investing in for dividends is foolish, that's not what I'm saying. When I'm saying making dividends your sole purpose for your investment portfolio, when that happens, yeah, then I think it's foolish. I think it's idiotic. But people keep doing it and they keep learning the lesson. But, the next crop of 70-year-olds, which will probably be my generation, I'm in my 50s, they will make the same mistake because every generation makes the same mistakes with investing over and over and over. Okay. So what else do we want to take a look at? That's really the big thing. Let's just take a quick look at some of the tech stocks. Okay. Here's the yield curve we're just looking at. Let's take a look at some of the big tech stocks because these stocks are so big that when they do poorly, there's no way the rest of the market's going to hold up. Let's get rid of that. All right. So Amazon down 1.25%. But if you come all the way down to NVIDIA was down almost 10% today. Nice that you had that reprieve, but I could see NVIDIA going back to where it was about a month and a half ago, which is about 90. Not a prediction. I'm just saying I could see that. I mean, I could see it going to 120 also, but you have to decide why you bought the stock. But Netflix, which just was hitting highs, is down almost 4%. Google down over 3.5%. They're having big antitrust problems. Apple down almost 3%. Microsoft, Meta, Tesla, Amazon. These are the big tech stocks. I always say, if you want to know how the stock market is doing, look at the big tech stocks. If you want to know how the consumer is doing, look at all the others, like Macy's and Abercrombie and Fitch and Nike and all those other, and Starbucks, Disney, and all those other consumer type stocks, both discretionary and staples. That's it for the show today. I thank you so much for joining me. If you have any questions, give me a call, send me an email, DM me, smoke signal me, whatever it is, and I'll be sure to get back to you. And I hope you are having a lovely day. Talk to you tomorrow.